You probably think your 401k is yours. You pick the funds, you set the contribution, you watch the number go up. But here's what the brochure doesn't mention. The moment that money enters a passive index fund, you stop being an investor. You become exit liquidity.
And before you close this video, because that sounds like something a guy with a podcast and a tinfoil hat would say, stick with me, because this isn't a conspiracy. It's just math. Boring, uncomfortable, completely legal math that the financial services industry would very much prefer you never sat down and thought about. Let's start with how we got here.
40 years ago, the dominant way Americans saved for retirement was through a pension. Your employer put money aside, professionals managed it, and when you retired, you received a fixed monthly payment for the rest of your life. The investment risk lived with your employer. You just showed up to work.
Then, in 1978, Congress quietly added a small section to the tax code, Section 401k. It was originally designed as a supplement for high earners, a tax-advantaged bonus savings vehicle. Nobody in Congress intended it to become the primary retirement system for an entire country. But over the next 2 decades, corporations realized something very quickly. Shifting from pensions to 401ks meant shifting the investment risk from the company to the employee. And just like that, the great American retirement system was quietly handed back to the people least equipped to manage it.
By the 1990s, index funds were rising. Jack Bogle at Vanguard had built the case that most active fund managers couldn't beat the market after fees. And he was right. The math was clean. Buy the whole market, keep costs low, don't try to be clever. It worked. Money flooded in. And it kept flooding in. Today, over $13 trillion sits in passive index funds. And that number grows automatically every 2 weeks when payroll runs across America.
Here's where it gets interesting. When you invest in a passive index fund, an S&P 500 fund, a total market fund, anything that tracks an index, you are not making investment decisions. The fund is. And the fund has one rule. Buy companies in proportion to their market capitalization. The bigger the company, the more of your money goes into it. You don't vote on this. You don't approve it. It just happens. This sounds fine in theory. In practice, it means that the composition of the index determines where your retirement money flows. And the composition of the index is determined by rules. Rules that can be changed.
Meet Sarah. Sarah is 34, contributes 6% of her salary to her 401k every month, and has it invested in a standard S&P 500 index fund. Sarah has never heard of NASDAQ's fast entry rule. Sarah has never read a 10K filing. Sarah is just trying to retire someday. But because of how passive investing works, Sarah is a guaranteed buyer of every company that gets added to the major indices. Not a potential buyer, a guaranteed one. Now, imagine you are taking a company public, a very large, very expensive company. Maybe one that isn't profitable yet, maybe one that has some assets the market loves and some assets the market definitely doesn't. Your biggest challenge isn't building a product. Your biggest challenge is finding enough buyers at the valuation you need. And if you can get your company into a major index, you don't have to find buyers. The buyers find you automatically every 2 weeks from the retirement accounts of 60 million Americans. That is not a conspiracy theory. That is the mechanical reality of how passive investing interacts with index inclusion.
And here's the thing. The rules around index inclusion have been getting more flexible, quietly. In May 2025, NASDAQ updated its fast entry rule, compressing the waiting period for new companies to enter the NASDAQ 100 from 3 months down to just 15 trading days. They also removed the minimum free float requirement that previously ensured a meaningful portion of shares were actually available to the public. And they introduced a multiplier that artificially inflates how a company's weight is calculated if its float is below 20%. Each change in isolation sounds like administrative housekeeping. Together,
together, they amount to a significant loosening of the standards that once created a buffer between a freshly listed company and the trillions of dollars sitting in passive funds. The 3-month waiting period existed for a reason. It gave the market time to do what markets are supposed to do: discover the real price of something. Price discovery is the process by which buyers and sellers, with different information and different motivations, collectively determine what an asset is actually worth. Compress that window to 15 days, and you compress the price discovery process, which means a company can enter the index and trigger automatic buying from passive funds before the market has had adequate time to figure out if the valuation makes any sense. Now, let's talk about who benefits from all of this. When a company goes public, there are insiders, founders, early investors, venture capital funds who have been holding equity for years, sometimes decades. An IPO is their exit. It is the moment they convert paper wealth into real wealth. And the size of that exit depends entirely on the price at which they can sell. For that price to hold, you need buyers, lots of them. Buyers who are price insensitive, meaning they will buy regardless of valuation because they are required to by the rules of the fund they manage. Passive index funds, by design, are price insensitive buyers. They don't look at earnings. They don't run discounted cash flow models. They just buy what the index tells them to buy. This is what is meant by exit liquidity. The insiders exit. The passive funds, and by extension the retirement accounts feeding those funds, absorb the shares at whatever price the market is at when the buying is triggered. Ray Dalio has said the bond market is the backbone of all markets. He's right. But passive investing has become the backbone of the IPO market. It has turned the act of going public from a process of genuine price discovery into something closer to a guaranteed distribution mechanism, where the product being distributed lands automatically in the retirement accounts of people who never consented to buy it and may not even know they did.
None of this means passive investing is wrong. The math still works in your favor over long enough time horizons. Costs are low, diversification is real, and trying to beat the market actively is still mostly a losing game after fees. But there is a cost that doesn't show up in the expense ratio. It is the cost of being a price-insensitive, guaranteed buyer in a system that now knows you exist and has started engineering around you. When index inclusion rules loosen, when waiting periods shrink, when float requirements disappear, the question worth asking is, who does that serve? It doesn't serve Sarah. Sarah just wants to retire. Warren Buffett once said that when a person with money meets a person with experience, the person with experience ends up with the money, and the person with money ends up with the experience. The financial system has a lot of experience. Your 401k has a lot of money. Jesse Livermore said there is nothing new in Wall Street. Whatever happens in the stock market today has happened before and will happen again. The mechanism changes. The dynamic doesn't. Capital always flows from those who don't understand the rules to those who wrote them. The rules just got rewritten, and the brochure still hasn't been updated.